When it comes to dividend stocks, there's a ton of great options for investors out there. You have low yield dividend stocks. Think of something like Apple or Microsoft, a low dividend yield, but packed with a lot of growth potential. Then you have moderate yield dividend stocks, something like Johnson & Johnson, around a 2 to 4% dividend yield, but a little bit less in terms of share price growth potential. And then high yield dividend stocks, more of an income play. But the dividend stock we're going to talk about today is packed with growth potential, a solid, safe, reliable dividend, and one of the fastest growing dividends on the market today. So if you're excited about today's video, do me a huge favor. Click that like button down below, as I truly appreciate it, and it really helps with the growth of this channel. And let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And quickly, I'd like to thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. Right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, now let's get back to our video in talking about what could be one of the best dividend stocks to own for the next decade plus. Not only is this company a dividend stock, but they are a dividend growth stock, one of the best there is on the market today. And without further ado, the company that we're going to take a closer look at today and do a stock analysis video is Broadcom, stock ticker AVGO. For those of you unaware, Broadcom has a market cap of $365 billion. The company designs, develops, and supplies various semiconductor chips and devices. Broadcom has roots dating back to 1961, when Hewlett-Packard spun off Agilent Technologies in 1999. In 2005, the semiconductor segment of that business was acquired for $2.6 billion from Avago Technologies, hence where the stock ticker comes from. And in 2009, Avago went IPO. Fast forward now to May of 2015, Avago Technologies announced its acquisition of Broadcom Corporation for $37 billion. And at that point, the company changed its name to Broadcom Inc., what it is known as today. An interesting fact, just a year later in 2016, Broadcom tried to do a hostile takeover of Qualcomm for roughly $117 billion, but that was blocked by the Trump administration, citing security concerns. So when it comes to Broadcom, one of the most exciting things as an investor is the growth potential moving forward, and AI has a lot to do with that. Broadcom operates within two operating segments, the first being semiconductor solutions and the other being infrastructure software. Broadcom has a number of different products, which only increases its reach as well as the company's investability. Broadcom has products within wireless, connectivity, storage, data centers, software, and cybersecurity, just to name a few. Oh, and how could I forget artificial intelligence, or AI. The bulk of AI-related revenue is found within the semiconductor solutions segment, which makes up, in terms of revenue, 80% of total company revenues. Broadcom management expects AI-related revenues to increase to more than $7 billion in 2024 and make up 25% of its current operating segment. In addition to the growth in AI, the company has a pending $69 billion acquisition of VMware, which could only further accelerate its adoption of cloud technologies, yet another growth potential driver moving forward for this awesome company. Now let's take a closer look at the company's financials to see just how well this company's doing. In Q3, the company reported total revenues of $8.88 billion, which was a 5% increase from the same period last year. Semiconductor solution revenue came in at $6.9 billion, with infrastructure software Q3 revenue coming in at $1.9 billion. That semiconductor revenue increased by 4.8% during the quarter, with infrastructure software climbing 5.2%. Revenues are great and all, but if a company isn't operating efficiently, they're not able to reinvest at the same level back into their business or grow their dividend. So let's take a look at a few metrics to see just how well the company is operating from an efficient standpoint. Adjusting operating income for the past 12 months was $21.9 billion, a 14.1% increase over the prior 12 months. Operating margin has increased from 60.5% to 61.7% over that same period. So improving operating margin, a great sign there. In addition, Broadcom has seen free cash flow increase 13.5% over the trailing 12 months to $17.4 billion. That equates to a free cash flow margin over that period increasing from 48.3% to 49.0%. So again, another area in where the company is improving its margin. And speaking of free cash flow, you've probably heard me say it before, free cash flow is what makes the dividend grow. On a per share basis, free cash flow for the company was $40.68 per share. Broadcom currently pays a dividend of $18.40 per share, equating to a free cash flow payout ratio of 45%, which is extremely healthy. The company currently yields a dividend of 2.1%. Broadcom has also been increasing that dividend for 12 consecutive years, and given that healthy free cash flow payout ratio, I expect this to continue moving forward. Broadcom has a very strong 5-year dividend growth rate of 21%, something that will be hard to beat looking across a multitude of different dividend stocks. Try and beat a 5-year dividend growth rate of 21%. So all of this is great and all, but is the stock right now a buy, sell, or hold? Results can be great, but if it doesn't equate to a good valuation, then it doesn't mean that it's a good time to buy this particular stock. So before we look at valuation, one of the risks that it comes along with Broadcom is obviously expectations for AI-related revenues being much too high. The other being is the fact that AI has been great here in FY 2023, but if you take that out of the equation for Broadcom, revenues were actually flat across all the other areas of the business. So if AI isn't doing great right now, we're talking about a completely different company. But on the flip side, if AI can continue to be that growth driver and we continue to see those other areas of the business creep back up and start moving and getting back into growth mode, that's just going to be another growth driver for the likes of Broadcom. In terms of the share price, Broadcom has been one of the best performing dividend stocks on the market as well. So not only did we have the best in line in terms of 5-year dividend growth rate, but we're looking at a performance that blows all other dividend stocks away. We're talking about Broadcom. Now, if you bring NVIDIA into the equation, that's a different story, but that's like a 0.04% dividend yield. This is a true dividend stock here. So Broadcom, just in 2023 alone, is up 60% on the year. Over the past 12 months, we're talking about a stock that's up over 100%. Analysts expect Broadcom to generate EPS of $46.05 per share in FY 2024, which would be growth of 9% from what is expected in Q4 this year. This equates to an earnings multiple of 19.2 times. For comparable purposes, NVIDIA trades closer to 30 times and AMD closer to 26 times next year's expected earnings. Broadcom trades at a forward multiple of 19.2 times, cheaper than those other semiconductor plays, but it appears expensive relative to the company's 10-year average of 15 times. Is the higher multiple compared to the company's recent 10-year history warranted? Well, one way to look at that is by utilizing the PEG ratio. The PEG ratio takes the price to earnings multiple, but then also takes into account the company's EPS growth moving forward. So right now we have a forward PE multiple of 19.2 times. 2024 expected EPS growth is 9.2 times. You take 19.2 divided by 9.2, you get a PEG ratio of 2.1. Usually when I'm looking for great value plays, you'd like to see a PEG ratio closer to 1. Ideally, below 1 is usually a great time and great value in terms of the price to earnings multiple that you're paying and the growth you're getting along with that. So when it comes to Broadcom, there's a lot to like about the business. If they can get their legacy products and services getting back into that growth mode, and then you tap into AI growth as well, you can just see the explosion that we could see from Broadcom. We're talking about cybersecurity has a long growth runway. We're talking about data centers has a long growth runway. Mobile devices can return here as well. And then you bring into the equation the growth potential for AI. This company has a long growth runway moving forward. But in terms of valuation right now, in full disclosure, I already own shares of Broadcom. So given today's valuation, looking at a 19 times multiple, historically closer to 14. Now I know there's a lot more growth impacted there, but that's why I wanted to look at the PEG ratio. PEG ratio is a little high. When we look at a price to free cash flow, that's a little bit higher as well. So I think right now, if we can get Broadcom under $800, that would be a time that I would probably look to add yet again to my position in Broadcom. But I have no doubts that over the next decade, if you look back, I believe, in my opinion only, that Broadcom is going to be one of the best dividend stocks that you could have in your portfolio. Not only is the growth potential there that we're talking about, but also the dividend. The dividend of over 2%, and you're getting a high 20% or even a high teens 5-year dividend growth rate. That is going to be phenomenal for those looking to compound their wealth through dividends. So I hope you enjoyed today's video, and in the comments section below, let me know, do you believe Broadcom not only will be a good dividend stock moving forward, but do you think it's a buy, hold, or sell at today's valuation? Thanks again for watching, and with that being said, we'll see you in the next one. Take care.